Hey guys, welcome back to Alpha Talks Finance. I'm Alpha, your guide to navigating the US stock market. Remember, Wall Street doesn't own the game, we all play in it. Now, let me bring up something wild that just happened in the market. Do you remember when Starbucks suddenly announced it was parting ways with its CEO Laxman Narasimhan? And then out of nowhere they poached Brian Niccol, the superstar CEO of Chipotle? That's right, it was a straight-up corporate heist. And guess what happened? The market went nuts. Starbucks stock jumped 24% overnight, while Chipotle tumbled 13%. In other words, we saw about $30 billion of market cap literally shift from one company to another. Just because of one person switching jobs. Crazy, right? But it actually shows us something very important. Good leadership can make or break a company. Warren Buffett has a famous line, "When a management with a reputation for brilliance tackles a business with a reputation for poor economics, it's the reputation of the business that remains intact. But when great management teams are in place, they can take even an average company and turn it into a giant." The problem is, most retail investors don't really pay attention to management. They're too busy chasing headlines or buying into hype. And to make things worse, we often get swayed by whatever a CEO says on CNBC without stopping to ask, is this person actually executing? Or just talking? The truth is, analyzing leadership isn't easy, especially for us retail investors. But that's not an excuse to ignore it. In fact, it's the opposite. Leadership is so critical that it can completely change a company's investment thesis. Let me give you a perfect example. Microsoft. Take a look at Microsoft stock from 2000 to 2013. It was flat, dead money. Their core PC business was stale, they completely missed mobile, and the company felt bloated and inefficient. Investors called it a value trap. But fast forward to 2014, and something small happened that changed everything. Satya Nadella became CEO. At the time, expectations were low. He wasn't a flashy name, but what he did in the following years shocked everyone. First, he had the guts to shift Microsoft away from its Windows First mentality and go all in on cloud computing. That pivot to Azure turned out to be one of the smartest moves in tech history. Then, he tackled Microsoft's culture head-on. His predecessor Steve Ballmer was known for being aggressive and fostering cutthroat internal competition, which killed collaboration and innovation. Nadella scrapped that, tore down silos, and pushed for a more inclusive, people-first culture. Employees felt re-energized, innovation started flowing again, and suddenly Microsoft wasn't a dinosaur anymore, it was leading the pack. Today, under Nadella, Microsoft isn't just a cloud powerhouse, it is positioned right at the center of the AI revolution, that transformation. 100% tied back to leadership. So when people ask, does management really matter in investing? The answer is simple. Look at Microsoft. Without Nadella, Microsoft was stuck. With Nadella, it became a trillion-dollar rocket ship. That's the difference leadership makes. It's literally the line between 0 and 1. Here's the flip side. If leadership is bad, it doesn't matter how good the cards are, you can still blow the game. Take Baidu for example. On paper, this company had the golden ticket. Google was kicked out of China, so Baidu basically had a monopoly on search that should have been a once-in-a-lifetime opportunity, but over the past 2 decades, they fumbled it. Why? Management. Baidu's leadership repeatedly sacrificed long-term trust for short-term profits, allowing shady medical ads to run unchecked, pushing misleading information, and even claiming credit for technologies they didn't actually build. When a company is run like that, investors might see occasional pops in the stock price, but long-term value? Forget it. It's a house of cards. Compare that to Microsoft under Satya Nadella night and day. Baidu shows us how poor leadership can destroy even the best setup, while Microsoft shows us how strong leadership can turn a stagnant company into a world beater. For investors, that's not just important, it's decisive. So the big question is, how do we actually judge management? Whenever I dig into this, one name keeps coming up: Warren Buffett. Buffett has been crystal clear for decades management quality is one of the single most important factors in investing. And he doesn't just talk about it, he practices it. Buffett often highlights 3 traits he looks for in leadership, and the very first one is integrity. Now, integrity might sound fuzzy or abstract, but in reality, it's easy to spot and it makes all the difference. Let's circle back to that Starbucks story from earlier. Why did the stock jump when they replaced CEO Laxman Narasimhan with Brian Niccol from Chipotle? It wasn't just about bringing in new blood. It was also about the market finally losing patience with a leader who lacked credibility. Think about it. Narasimhan took over in 2023 and immediately raised coffee prices. But instead of boosting results, growth slowed down and eventually turned negative. Naturally, investors started asking tough questions, and his response. On the latest earnings call, he blamed the weather for slowing foot traffic. Seriously, the weather? He basically said, "It's not our fault, it's just that the climate wasn't cooperating." Of course, nobody bought that excuse. CNBC's Jim Cramer even called him out on air. "I track every beverage and fast food chain out there. No one else is blaming the weather. Maybe it's just that your coffee is too expensive." Instead of owning up, Narasimhan doubled down, saying that the decline was really about occasional customers who don't understand Starbucks value. What does that even mean? It sounded like deflection and worse, like dishonesty. And here's the thing, once investors start doubting your honesty, you're done. The board clearly felt the same way, which is why they pulled the plug and brought in Niccol. Now compare that to McDonald's. They've been facing the exact same issue, slowing growth as they raised prices. But how did their leadership handle it? On their earnings call, they came right out and said, "Yep, we raised prices too quickly and it hurt demand. So we're fixing it with a $5 meal deal to bring customers back." That's the difference. Honest leadership admits the problem and lays out a plan to fix it. Dishonest leadership makes excuses until nobody believes them anymore. And this is exactly why Buffett values integrity above almost anything else. Because if management can't be straight with investors, it doesn't matter how good the business looks on paper. Without trust, there's no foundation. Warren Buffett once made a sharp observation. A CEO who misleads others in public will also mislead himself in private. If someone is always making excuses in front of the public, it shows that he's unable to face his own problems. In running a company, such a leader is likely to keep excusing himself, avoiding the real issues instead of solving them. That's why, if you see a management team constantly dodging questions instead of confronting problems directly, you need to be very cautious. These flaws often show up during public interviews or earnings calls. As long as we pay attention, we'll definitely be able to spot them. The second quality Buffett values most in management is whether they have a long-term vision. Buffett has said many times that too many executives are obsessed with short-term stock prices while ignoring the company's long-term growth. That is why he and Charlie Munger place great importance on whether a leader can think far enough ahead. Take GM's management as a classic example of short-sightedness in the early 2000s. Facing fierce competition, the company cut costs at all costs. They not only slashed R&D but also abandoned the product quality they were once proud of. This directly led to a total collapse of their product line just a few years later, and in 2009 GM had to file for bankruptcy protection. Another example is Wells Fargo. Its management pushed extremely aggressive sales targets just to meet short-term goals. Under pressure, employees resorted to opening massive numbers of unauthorized accounts. Once the scandal was exposed, Wells Fargo faced billions of dollars in fines, lost huge numbers of customers, and its stock price never recovered. By contrast, Amazon is the perfect representation of long-term vision. Amazon's success today is closely tied to Jeff Bezos' almost stubborn commitment to long-term thinking. As early as 1997, in the company's IPO shareholder letter, he made it clear that Amazon would focus on long-term growth, not short-term profit maximization. He also said that every major decision Amazon makes would be based on its long-term impact, not just to satisfy near-term market expectations, and Amazon has indeed followed through. For years, the company maintained razor-thin profits and poured money into future investments. The criticism never stopped, but Bezos never wavered. He kept pushing his long-term vision. Projects like AWS and Amazon Prime are classic examples. Both required massive upfront spending and produced no visible short-term results. The market doubted them, but under Bezos's persistence, both businesses turned into massive successes. For most management teams, projects like AWS or Prime would have been abandoned halfway through. The payoff horizon was too long, and too many risks could derail them. But Bezos stuck to the long-term game, and that's why Amazon has the success it enjoys today. That's why long-term vision in management is absolutely critical for us as investors. If you see a CEO overly focused on short-term stock movements, rushing to calm the market whenever the stock dips, or making hasty, short-sighted changes, that's a red flag. You wouldn't want to entrust your money to such a leader. A good management team should stick to the right long-term decisions and not be easily swayed by market noise, as Buffett put it. Time is the friend of the wonderful company, the enemy of the mediocre. That's exactly the point here. The third quality Buffett values is whether management is truly accountable to shareholders. Buffett has said that poor managers often don't consider shareholder interests. That is why many of the companies Buffett invests in are willing to return capital to shareholders through dividends or share buybacks, classic ways to reward investors. This doesn't mean that only dividend-paying companies have good management. The deeper meaning is this: when a company doesn't see high-return projects, does management put shareholders' interests first? Or do they make foolish decisions, chasing unnecessary investments and expansions? That's not easy, because many executives want to prove they're not mediocre, so they often force themselves to do something rather than practice restraint, simply paying dividends or buying back stock. Buffett himself is an excellent example of discipline. If he doesn't see good opportunities, he would rather hold a large cash position than force investments into companies he doesn't believe in. Even though Berkshire Hathaway doesn't pay dividends, Buffett's ability to withstand pressure and avoid foolish investments is itself a strong form of accountability to shareholders. In summary, Buffett believes that the three most important qualities in management are: 1. Integrity, the ability to face problems honestly, both publicly and privately. 2. Long-term vision, prioritizing sustainable growth over short-term market reactions. 3. Accountability to shareholders, making disciplined, rational decisions that protect shareholder value. And as we've seen since then, Boeing's stock performance, along with its repeated scandals, have only validated my judgment. That, in fact, is the very reason I wanted to make this video today. In investing, management often gets pushed to the back of the priority list. People prefer to focus on stock price movements, earnings performance, or exciting long-term narratives. But in reality, the people running the business matter most. With trustworthy management, you can still believe in a company even in tough times. You can trust they'll steer it back on track, and you'll be willing to let them manage your money. But with untrustworthy management, for long-term value investors, it's a non-negotiable risk. Bad management can amplify every challenge: macro pressures, competition, or even pure accidents, making your investment dramatically riskier. Sometimes the company may not survive the hurdle at all. This is why, even if a company has a great story or strong earnings, poor management can turn it all to ashes, and we've already seen too many such cases in the US stock market. Now that we've understood the importance of management and how to analyze it, I encourage you to apply this framework to your own portfolio. You may find that some of your investment decisions change once you add this layer of thinking. Of course, analyzing management isn't as straightforward as analyzing a financial statement. It takes time, observation, and accumulation, but at least now we have a framework. Next time you hear a CEO's statements or watch their actions, you'll know what to look for. If you'd like to go deeper into evaluating corporate management, make sure to subscribe to my channel. I regularly share stock analyses where I put all my years of market experience into practice. It may not always be 100% correct, but at the very least, it's a useful reference that can save you a lot of time. And if you want to sharpen your management analysis skills further, there's also a more quantitative approach, looking at executive compensation structures, equity ownership, governance mechanisms, and management independence. These quantitative indicators can give us quick insights into management's decision-making logic and underlying qualities. If that interests you, subscribe and stay tuned. I'll be sharing more in upcoming videos. In tomorrow's video, I'll be breaking down one of the hottest topics in tech right now: humanoid robots and the investment opportunities behind them. For years, humanoid robots have been a pretty controversial space. Some argue there's no real need to make robots look like humans. They're expensive, slow to iterate, and unnecessary. Others believe that because our entire society is built around the human form, only humanoid robots can truly unlock the highest potential for real-world applications. With the rapid progress in AI lately, this debate seems to be leaning toward a clear answer. Humanoid robots are entering a phase of explosive growth, and plenty of new opportunities are starting to surface. But here's the catch: investing in this space is not easy. If you're only buying into the hype and the big stories, you're very likely to step on a landmine. That's why in the next episode, I'll analyze the humanoid robot sector from an investor's perspective and walk you through the real risks and opportunities. So if this is something you're interested in, make sure to subscribe to Alpha Talks Finance. And if you enjoy my content, don't forget to like, subscribe, and share. Thanks for watching. I'll see you in the next one.